Good afternoon. Welcome to Brown Bag Friday. It's November 20th and a good day here at State Fair Community College. As we prepare for the conversation today, I just want to give a little background. When the college was preparing in March for a budget for this fiscal year of 21, we were on track to meet our budget in a good way and give employees a salary compensation and also to look at potentially some things out of program review. When COVID hit, all of that came to a screeching halt. As you know, our budget was impacted with a reduction last May and June at the end of fiscal year 20. And then for this fiscal year 21, we also had a state reduction. And we had anticipated that there would be a state reduction. It was a little less than anticipated. We also didn't know about enrollment, and it was a large variable. So Keith and the administrative team put together a budget that we felt good about, and Keith's going to talk more on that. But we did say at the time we would review the budget because the variables were so great that here in November, it was the right time to look at where we're tracking for this fiscal year. And if we could recognize employees with a salary compensation for the second half of the year, that we would look at that and see if we could make that recommendation. Well, the good news is that yesterday, Keith took to the board what you're going to see, that it looks like we're on track to have a good year this year because of the things that we did with the budget last year. And we did talk to the board about recommending a salary increase for employees beginning effective January 1 of 2021. And we're going to talk to you about that today. So we just say, thank you for sticking with us. Thank you for understanding that while our budget was prepared as best we could last year, we've been tracking a little better than budget. And so Keith, thank you for the work that you did in Keith has really done a lot of work in helping us look month by month what our typical flow of revenue and expenses so that we can project out now pretty effectively to the end of a fiscal year. So Keith, welcome. We have Vice President Keith Acuff with us here today and Executive Director of Human Resources, Rachel Dawson. So thank you both for joining this brown bag to actually share some good news with employees that the trustees, while they didn't formally act on the recommendation of a salary increase, they were all very supportive, and that gave us the green light, the thumbs up, to bring it back for a formal proposal in December, which is what we're going to be doing. So I know if you're watching this live, you're able to ask a question. We are tracking what might be on Facebook Live, and Brad Henderson is going to tell us that. We have gotten a few questions that we'll try to answer at the end, but the big one really is, Keith, how did we come to the conclusion that we could propose a salary increase for our employees here in January? And how does that impact our budget, not only for the remainder of our fiscal year 21, but how does that impact us going forward so that obviously we don't want to have to do reductions of staff again or do other severe budget cuts into the future. So I'm going to turn it over to you for some remarks, and then I think you got a spreadsheet you'd like to show.
Well, we get the spreadsheet in a minute. So when doing a budget, and I've done many of them in my life, the biggest issue is not necessarily the increase or decrease of the budget. It's the potential variability and the kind of outside factors that come into play that can force you not to be as certain of the variability. And as Dr. Anderson mentioned, in the spring, we had tremendous variability. No one knew what COVID really was. We weren't sure of the tremendous impact. We knew it was bad, but we really didn't know where it was going. There were no real effective remedies. The whole thoughts of vaccines was just getting going. There was just, so the variability made it very difficult. And in those situations, the job is to make sure that we have a budget sufficient to meet our needs, and if it were to take a variance in the wrong direction. So we built a budget accordingly, and it was the right thing to do. Everything we knew at that point was uncertain. But since then, some things have happened. We are still down enrollment from last year. Our tuition and fees revenue was down 6.5% from last year. But it is ahead of where we thought it would be. The state has reinstated some funding that we did. So there are a number of variables that have come into play that allow us to look ahead. And while the spring is uncertain, in truth, it's not as uncertain as it was last spring. We do know that there are vaccines coming out. We do know that there are treatments out there. We understand that the impacts of it. We understand what works and doesn't work in terms of masking, in terms of social distancing. So there's a lot of things we've learned now. Whether we practice all that nationally or not is an issue, but we do know those things. We have 6 months of experience at the state level and our level dealing with this. So while it's uncertain, truthfully, the uncertainty is not what it was 6 months ago, which is why we feel much better about looking at where we go, where we are right now, and where we go next year. So let me pull up the budget summary I gave to the board. I'll review it with you. I'll walk through it in detail. It's a 30,000 foot view. It's a macro view. What it does is it takes what are the macro influencers impacting us right now, not trying to look line item by line what you're spending, but what are the things external and what are the big changes that we know are happening and can plan on, knowing that from just an everyday budget item, you all are tracking very, very well. We watch our budgets well. The operating budget is there. So let's look at influences. Let me get the screen up and we'll walk through this. First of all, I need to ask, can you all see do you see everything, or is it cut off on the left and right?
No, it is there.
Good, because mine's a little cut off on my screen. So
well, far right, I'm not sure we're all the way to the, I think so.
Okay, we'll get there.
FY22 budget is the last column. Yep.
Okay. Actually, we'll need to move that over just a little bit. I'm going to make this just a tiny bit smaller here to help us out down the road.
If you could get rid of that last column.
And will all this stuff over here, the tools and all that?
Yeah.
How about this? What does this do?
There you go. That's good.
I'm learning. So we looked at, you'll see on the left, the very left column are our key, just really a very, very, very high level revenue categories, which are three main revenue categories: are tuition and fees, state appropriations, and property taxes, and literally all other. And you know, and a lot of the all other is the pass through scholarships and things like Pell Grants and subsidized loans, all of those things. And then from an expense standpoint, our big items are wages, and payroll, wages and fringe. I want to talk about outsourced services in the course of this, and hardware and software, and then all other, which again is a lot of pass-through costs. But the budget you see in the green column, that was the budget exactly as presented to the board of directors in June and what they approved. And it includes everything. It's beyond our operating budget, but it's everything included. And what we'll talk about the changes are to the operating budget. So we're through November now. So we're through 5 months of the fiscal year. With that, I'm able to have a very good projection of tuition and fees and state appropriations. Right now, our budget through the first 5 months is on pace to be 5% ahead of where we had budgeted to be. Like I said, it's 6.5% less than last year, but still 5% ahead of the budget. That variance is a positive $727,000. If nothing change, if everything stays the same to prior years, and that goes through to the spring semester, we have no reason to believe right now that the spring semester enrollment will deviate to any significant degree from that pace. Obviously, still less than last year, but on pace to be what fall was relative to that. So that, and assuming that keeps going, that's the adjustment we have. State appropriations. When we started this, we had just come off of 2 months of the state withholding funds at the end of last year, and telling us that we would probably at that amount for this coming year. So we budgeted accordingly. Since then, number one, they withheld a little less than that to start with, and they've given back some funds that they had taken away from that. So instead of having a state appropriation budget of 4.8 million, our state appropriations will end up being right now 5.6, or a difference of $816,000. You ask, could that potentially be withheld at some point in time? Yes, something could. But I do know, I think the legislature, the budget office, OA, they've looked at the budget pretty hard. They know what's going on. They don't want to. They're actually conservative here because they didn't give it all back. They withheld some already. So the withholding they did is still being withheld. So they haven't reinstated it. So I feel good, and I think the Department of Dude feels good that that will stay that way for this fiscal year. So we have a positive budget variance this year. We're looking at about 1.5 million in that. Very strong. So now let's look at the expense side. Because of the way, really it's attrition, you know, people tend to come and go throughout the year. So we may have a position that was open and budgeted for, but maybe we didn't hire it right away, or, you know, somebody left and we didn't find time to get them rehired. Those kind of normal variations in the year tend to, and as you see in this case, make your salary budget a little less than what you expected because positions aren't 100% full all the time. And that's happening this year. We're actually on pace to be about 1.7% below actual budget, which is pretty typical in my history of the way hiring and terminations and people resigning and retiring and refilling those positions work. But anyway, it amounts to a positive variance of about 250,000 in salary. Our fringe is pacing right on where we thought it would be with that. So that's fine. I want to talk about outsourced services. The blue column with the $100,000, you'll see an increase there. Outsourced services, just so you know, is Ellucian. That's what it is. That's our IT staff, and they are. You may or may not know, but our IT staff is provided on a contract basis by Ellucian, and we pay them a fee for that plus all the other things they do for us. When we were in the spring and we were very uncertain where we were going, I went to Ellucian and asked them for their help with the budget. In fact, I asked for help of about $200,000 reduction in their fees to us, just not a deferment, but literally a reduction. They went to their management on our behalf, asked their senior management if they could help us out. They came back and said that, you know, $200,000 is difficult fees with no recourse, and we're not going to ask for it back, to the tune of $100,000 for us, which was essentially a 5% decrease in their fees. So, which I thought was in the end very much a partnership with them, reducing their fees by 5%. It'd be like if all of us took a 5% pay cut effectively. So they did that. But I had budgeted for 200,000 less. So that's why you see the 100,000 back in there, but it's still 100,000 less than last year. So I want to recognize what Ellucian did for us overall in that, just understanding that I had aggressively put in the full 200 and they gave us half of that, which is still very, very good in their part. I want to talk about the 125,000 less I'm showing in hardware and software. We're actually spending about we're going to be spending close to probably $1.5 million in hardware and software before the year is over. Most of that is being taken up by CARES Act money. One of the good parts of CARES Act is some of the money we had already budgeted for hardware and software, computer refresh, other things, just happens to fall within the guidelines of what CARES Act will cover. So there's about $125,000 that would have normally been, that was in our budget, that fortunately meets the criteria for CARES Act reimbursement. So it goes in the category of being reimbursed by CARES Act, not as our operating budget. So that's why while we are spending it, the source of funding it is different. So accounting wise, it results in an actual decrease in our operating budget, or decrease in our expenses for that. So between that and that, we're looking at a positive variance this year of about $1.8 million. That's wonderful. That's good. It allows us to do some things that had the pandemic gone the other direction, we couldn't have done. It allows us some things that had we decided not to go this route, we might not be able to do. But my job here is to be sure we're prepared for the worst and able to take advantage of the best. And that's where we were. We were prepared if things had gone, the variance had gone dramatically the other direction. And it could very, very easily could have. We could have been shut down for 3 or 4 months, anything, but it didn't. And because of that, we're able to do the things we're going to do this year and next year to make up for that. And you're right, there is uncertainty next year, but this gives us a bit of a cushion that if we do, and if we do shut back down again, all those things happen, we've got the cushion to do that as well. So with that in mind, Dr. Anderson asked me if I thought it would be possible to mid-year do a salary increase. Wanting my perspective on it. So my perspective, her, after looking at that, said, yes, I am very comfortable doing a mid-year pay increase given the less uncertainty last year and the amount of the variance that we do have. So she and ELT have proposed, and she mentioned to the board an increase that is, you've told them, right, Dr. Anderson? We'll go ahead.
Yeah. Can I explain that?
Yes,
so
please do.
When we had to go in and do budget cuts to provide, a positive budget proposed for FY21, we did some drastic cutting. Some of us took a voluntary pay cut, some took furloughs. We did reduce some positions, and we also eliminated the online differential, the summer differential, and those primarily they do impact faculty, and we did a lot of other budget cuts. So when we were thinking about this salary increase, we said that a big cut went to our faculty, and we were hoping that we could look at a scenario where we could add some to the base and then give our faculty a step increase, and then also give staff an increase. Now, some staff, some of our professional staff, because we did away with cell phone stipends, lost that. But overall, the bottom line was we didn't cut base salaries for staff or faculty, but there were differentials that were eliminated. So what we are proposing is to add 1.5% to the current faculty base across the board, and then have faculty get that step. And so for some individuals, if they are at the bottom of the salary schedule and can't go anywhere with a step, it's 1.5%. For others, it's anywhere from maybe 3.5 to 5. I think Rachel had looked at what some individuals will be getting, because it does vary depending where you are, if you're a faculty member on that schedule. For staff, we are proposing a 2% increase in their current salary. So the figures that you're going to have here Keith talk about includes that 1.5% to the base for faculty plus a step, and a 2% increase for staff. And then of course, it would be for only half of the year, because we're saying this is effective beginning January 1 and going forward. So Keith can talk about those numbers.
So if you look on the second blue column to the right, the pay increase. So Rachel went through and update and looked at what that would be. So on an annualized basis, those pay increases would amount to $280,800 in wages. And so from a budget standpoint, it impacts us half of that this year, 140 and 20. So you can see that the impact in this year's budget is 160,000 variance negative, when I'm looking at 8.4, potentially 8.4 positive variance. So there's a tremendous amount of room there that even if things change a little bit in the spring, that's why I feel very comfortable that we can absorb this easily. Question becomes, what about going forward? What about next year? What does that mean? And there are some known changes we already have this year that we've got to take into account as we look forward. And these are presented to the boards, public knowledge, so we present them to you. One of the things, and I'll just go down the third right-hand column, which says known FY22 changes. you'll see an all other income negative of $333,295. Let me tell you what that is. When we were looking at the budget this year, Mary Troiner and the foundation graciously stepped up and said, look, we understand this is a difficult time. We want to help out. So they said that, so typically the college covers all salaries of everybody, include foundation and the DOM. They're part of our operating costs. They're part of what makes us who we are. They're part of our attraction, in terms of raising funds, in terms of bringing notoriety to the college. She said, what we will do is we will step in for this year, utilize some of our foundation funds and cover the salaries of both the DOM and the foundation employees. That amount is $333,295. That will come back into our budget next year, as it has been every year prior to this. So it was a 1 year, and we'll help you out. So that comes back. We will then have to, the other half of the wage increase we're doing right now, the 140 and 20, that comes into the budget for next year. And outsourced services, the 100 that Ellucian took out this year will come back. Plus, on the overall, they'll have a pay increase for their associates, which factors into our budget as well. So those are both the reduction in, the reduction in revenues and the increase in pay. So those two net out to a $644,000 differential to where we are this year, which is still easily absorbed given the 1.6, the yellow column, the 1.6 adjusted budget this year. As we look out into next fall, there are obviously some assumptions that come into play and some understandings. For the purposes of this budget right here, we are looking at a neutral, basically a no increase or decrease in tuition fees or revenue. That could mean meaning that we're not decreasing enrollment, or it could mean that once we see where enrollment's going, that we and fees to adjust for that change. So if we know we're losing, maybe on pace to lose 1% in our enrollment, our tuition fees go up to compensate. We'll watch that as it goes along and adjust accordingly. Within the conversation among other folks in the community college system, I know amongst my CFOs, others, there is a feeling that we could at least stay flat, if maybe hopefully go up a little, simply because a number of students decided to effectively do nothing this year. They stayed out. They, to use the popular term gap year, but another term is they simply were just nervous about going in this year. So there's potentially a latent demand, an audience there ready to come back that hasn't come back. But as we do that, we're going to work to keep, if we get an increase in enrollment, we'll keep tuition and fees the same. If we get a slight decrease, we'll adjust accordingly. So that's why you see nothing in tuition and fees just yet. The state has told us that the remaining appropriations that were taken out this year, the ones that would originally been part of the fiscal year 20, will be brought back into us. So in addition to what they reinstated,
that's the goal. We always have to say they hope that's their plan.
That is their plan, to make us whole to fiscal year 20.
Yeah.
We'll have to see what's going, but what's been very positive in the state of Missouri, and I don't understand it, is our state revenues have actually been higher than they were last year, the last couple of months. That the appropriations from sales tax has been up over the same time last year. So I guess everybody's spending their money in state and not going out of state spending it, but that's why they instituted what they did, that literally they've had a positive increase in state revenues. And that gives them the feeling that we can do these things that they're saying and reinstate it. So that's another change that we are anticipating. You'll see a column there for wages and fringe going up. So the wages you see of 298 would be was the question that Dr. Anderson asked, of what would the impact be if we added another step in July, as well as a 2% increase going on. That would amount to approximately $298,000 in increased cost to us on top of the 140 that's going on. You see 357 increase in fringe there, a number higher than the increase in wages. You say, what is that? Well, part of it is the additional fringe, which is about 40,000 of it and those are in the notes down there, 40,000 or so on the the actual increase in the pay, but it's also our healthcare premiums. We are anticipating, this year we've been told that we should expect up to and maybe higher than a 15% increase in healthcare premiums. And Rachel's out here going, yeah, but we need to be very, very aware of the health dramatic increase this year. Not only just their normal increase, but they are related to some of the things happening, obviously with the pandemic, other issues. And that is significant impact on our budget that we have no control over. So we need to put it in there. But when you do all of that, with the state appropriations in there, it brings our budget to a variance of 270. So we're still looking next year at a positive going in right now, as they like to say in sports terms, the way too early projection of still having a positive budget variance. We'll know more about that here in the next couple of months as the state puts together their final budget for the year, as we see what happens with the enrollment, as we see what happens with the pandemic, as we see what happens with the new administration. There could very well be a new coronavirus relief aid package come out in the spring with that going on. So there's a lot of things can go both directions. But this is what we showed the board. This is what I feel very, very comfortable with right now, knowing what I know right now at this point in time, which is subject to change, but also knowing that my belief in the variability, while it's still there, is less than it was 6 months ago. And it's why we are recommending the increase in wages right now for mid-January, and understanding the impact and the potential for it in July, so that we can see right now that if certain change, we know ahead of time what the variables could be that could impact us, and we're able to respond appropriately and intelligently right now, because we've already looked at what it means to us already.
Thank you, Keith, so much. The biggest unknowns in that last blue column really are, will state appropriations go back to the FY19 year level, that 386? And then, we've given it a best estimate on the fringe for the healthcare. So we know that we can sustain a salary increase yet in this year, and we can sustain that salary increase into next year. Obviously, we would like, as we always do, want to give a salary increase, that 298. But say if that's not affordable because the state does something different, at least this gives us something to look at and a goal to be heading toward. So a question that had been submitted ahead of time, we said people could do that. Would it be better to look at positions that were cut instead of giving people a salary increase? Should we be bringing back some of the positions that were cut? And Rachel, I'm just going to kind of let you take that and answer.
So, sorry, Keith, with your, I have to move the people around. Oh, that's helpful. Thank you. So with the positions that were cut, there was a lot of discussion, and I know everyone knows this already, but I just want to repeat that there was a lot of discussion that went into those decisions. And while the budget issue was one large factor in that decision, it wasn't the only factor in how those decisions were determined. So that's really one of the things to draw attention to that question, is that there were other factors that went into it, such as efficiency and productivity. And I know there's some concerns about, well, people had to absorb those extra duties, and that's true. So at this point in time, there's no discussion to bring any of those positions back. We were very lucky to be able to rehire some of the people affected in those positions into other positions that were needed positions. But I would just suggest, one of the questions that had come through, I would suggest that if there are concerns out there related to additional duties because of those positions, please take those to your direct supervisor and roll them up through the ELT. We did have extensive conversations regarding that. But if something's happened in the last 6 months, I think, it definitely warrants that conversation. But that's where those conversations have to start, is with the direct supervisors. Yeah. So just to reiterate, at this point in time, we're not looking to bring any of those positions back. Some were hired in at part-time, and that was always the plan. So while we eliminated a full-time position with benefits, we did hire back part-time, such as the assistant men and women's basketball coach positions. So hopefully that helps a little bit with that question and that concern.
So I would just add to that in that we're not bringing back any of those positions now. Any positions that will be considered will be put on a priority list that we do every year to look at what positions, what budget needs that are not currently in the budget that we need to prioritize and see if there's a budget that can sustain those going forward. So positions that are needed will be put on a list for prioritization for our FY22 budget. And as Rachel said right now, none of those are there, but it's possible that something could occur there. You know, one of the concerns that staff have always had too is that we have a tremendous health benefit. And so I think they were able to see on that chart that Keith has projected what that increase might be. And that would still be providing a 100% covered health insurance benefit for our employees. I know that discussion has come up over time. And Rachel, you are putting together an HR advisory committee that will help us look at that and make some decisions on that, as well as some recommendations for all of our benefits and compensation going forward.
Correct. Yeah, just really quick, because I don't want to go over our time, but as you may have seen in the weekly, and then also I think a separate email went out today that I am accepting applications for those interested in being on the HR advisory committee. I'm really excited about this. The priority right now, just due to time constraints, is the benefits package, because when we moved to United Healthcare, we had a 4-year deal with them, not a contract per se, but a deal where we got a discount. Because that discount is expiring this next year, that's where that 15% budget plan is for the benefits. At this point, because of COVID, United Healthcare essentially shut down for months. So our broker hasn't received any information. They're just now getting that. So that's the best projection that we can come up with. But so that's a time-bound issue where we need to discuss the benefits. And I want to involve a cross-functional team to be able to get input from all areas of the institution on what's important to them for benefits. As we've heard from some of the questions, it's really important that we continue to pay for our health insurance. So that's one piece of that. And that will be a big discussion point of that HR advisory committee in the next few months.
Okay. Lastly, I would just say, as if you are having meetings with divisions and or directors and you would like Keith or I to sit in on those and explain what the recommendation is going to be that goes to the board in December on the 17th, please invite us. You will also, anyone who has currently had a contract issued to them, there will be an addendum to that contract that you will be getting from Human Resources. They're working on those now, but it won't be final until after the board accepts this recommendation at their December meeting. You know, we only had one comment, and basically it was from Brendan Borman, and he said, "Good job, Keith." So I'll just leave it at that. Good job, really good job to all of you who have watched your budgets, who understood the challenges that we faced, and just thank you so much for your continued service, your great work this semester. And again, happy Thanksgiving to all of you.